Tesla's stock took a hit after its latest earnings report, but here's the fascinating part. The sell-off might not tell the whole story of what's actually happening beneath the surface. Welcome back, and today we're diving deep into Tesla's post-earnings turbulence and why Wall Street's reaction is far more complicated than a simple decline in share price would suggest. So let's start with what actually happened. Tesla reported its quarterly results, and investors were not impressed. The numbers disappointed on key metrics, triggering an immediate sell-off in shares. This is the kind of reaction we've seen before with Tesla, a company that has almost become its own financial phenomenon, separate and distinct from the normal rules that govern how markets typically respond to corporate performance. But what's particularly intriguing this time around is the undercurrent of market speculation that analysts believe could actually keep the stock from falling into a prolonged tailspin. Here's where it gets interesting. Tesla is not just a car company in the eyes of the market. It never really has been. It trades as a technology stock, a clean energy narrative, an artificial intelligence play, and increasingly, a robotics and autonomous vehicle speculation machine. That layered identity creates something genuinely unusual, a situation where poor quarterly fundamentals can coexist with persistent bullish sentiment, because investors aren't necessarily buying what Tesla is today. They're buying what they believe Tesla might become. And that speculative premium is extraordinarily difficult to dislodge, even when the earnings disappoint. Think about the broader market context right now. We're living through a period where AI-adjacent stocks command almost irrational enthusiasm. Tesla, through its autopilot and full self-driving development, positions itself squarely in that conversation. CEO Elon Musk has been vocal about Tesla's ambitions in robotics through its Optimus humanoid robot program, and that narrative alone injects a significant speculative cushion into the stock's valuation that pure fundamentals simply cannot explain or eliminate. Now, let's be precise about the risks here, because this is where the analysis gets genuinely sobering. Speculation is not a foundation, it's a structure built on confidence and momentum. When either of those erodes, the unwinding can be swift and brutal. Tesla's core automotive business is facing real competitive pressure. Chinese manufacturers like BYD have been aggressively challenging Tesla's dominance, particularly in price-sensitive markets. Margins have been squeezed as Tesla has repeatedly cut vehicle prices to stimulate demand. These are not temporary headwinds. These are structural challenges that will require concrete operational answers, not just compelling future narratives. The question analysts are genuinely wrestling with is this: how long can speculative enthusiasm outrun disappointing near-term performance? History gives us mixed signals. In Tesla's own story, we've seen the stock defy gravity for extended periods, only to eventually recalibrate sharply when sentiment shifted. The danger is that retail investors, who hold an unusually large portion of Tesla shares compared to most major companies, can be particularly vulnerable to these cycles, buying on enthusiasm and panic selling when the music stops. There's also the Musk factor, which is impossible to ignore in any serious Tesla analysis. His personal brand, his other ventures including SpaceX and XAI, his political entanglements, all of these create a noise layer around Tesla's stock that can amplify both the upside speculation and the downside volatility in ways that are genuinely difficult to model or predict. So where does this leave Tesla shareholders and market watchers right now? The stock may well find support in the short term, buoyed by ongoing speculation around autonomous driving breakthroughs, robotics commercialization, and AI integration. But the deeper question that no speculative narrative can ultimately escape is whether the underlying business will eventually grow into the extraordinary valuation the market continues to assign it. Because in investing, as in everything else, reality has a way of catching up, and the only real question is when.